Hi there, and welcome back to the Metaverse Stock Exchange. This video will be a stark warning if you're thinking about getting into the market right now. And why that is, I will tell you what has happened, what is happening right now, and what usually happens. And then you can make the decision for your own based on your risk preferences. Is it a good time for you to get into the market or not? So let's dive into the numbers. Just looking at the indexes, the month of January has been pretty much one of the best months for stocks in a very, very long time. And as you can see, just from the broad indexes, so we have the S&P 500 up by almost 7% in just 1 month, which is normally the yearly performance of this index. But if we look at the higher beta, or a little bit riskier stocks in the technology sector, which is the NASDAQ composite, we see this index up by almost 14%. So pretty much doubling the S&P's performance. But that doesn't stop there. If we look at the riskier parts of kind of technology or more speculative, let's say, like Tesla or Meta, they have been both up. So we have for Tesla 64% for the month of January. And this is not even for the entire month. This is just 1 month from February 6th going back. So the from a year to date, it's even higher than that. And then we have 48% for Meta in just 1 month. So in 1 month, 50% and 65%. And if you think that's a lot, then we go to the even pretty much the most speculative parts of the markets, whether it's our meme stocks, AMC, GameStop, Bed Bath and Beyond. In here, we had a dip pretty much yesterday, but if we take even with that, we can see numbers of 60%, 30%, 90%. But before that, if we go here, we had Bed Bath and Beyond at plus 300%, so almost 300% for the month, for the past pretty much 30 days, which tells you that there has been a lot of kind of enthusiasm and mostly options trading in the markets. And if you want to look at the data, we have another data point here that tells us that. So this is from the Wall Street Journal and JP Morgan. So the percentage of total trading volume coming from retail investing was about 23% from January 25th to February 1st. So this is just this week, because this was the crucial week when pretty much you see this spike happen, and a lot of the indices kind of took off there as well. JP Morgan's Peter Krieg wrote in a note to clients this week, narrowly edging out the record retail share of 22% in the pandemic-fueled trading frenzy, which this week had more retail participation than even the highest peaks in the retail frenzy when everybody was at home and everybody was kind of trading. So that's one indicator. And we have another indicator that tells us that last Thursday, we had the highest option trading volume in 1 day. So why is all of this important? It is important because this is pretty much the first stage of how markets rally up very fast. So first, you have a market that has been down. And as we know, the market was down during the year of 2022. Then it starts rallying up. As soon as soon as indexes start rallying, as soon as all of these kind of more speculative stocks, especially like Tesla, start going higher, then retail sees that and says, okay, I'm going to jump on this train and do the momentum trade, right? So then they jump on Tesla, but at the same time, they jump on other stocks like Meta, and then they go to the speculative stocks, and that kind of fuels the rally even more and more. And as the rally goes on, then there's even more trading in all kinds, all sectors. But because there's so much options trading right now, and there's so much retail demand, when retail gets into the markets, then institutions follow, because most of the trading today is algorithmic or computer trading. And the computer see the inflows, see the buying, and they're pretty much programmed. If there is more buying, if there is interest, if stocks are going higher, they are going to buy in as well. It's pretty much a program, right? It also wants to get into that momentum trade. So first, the retail investors kick in. then it's the computers, then it's the hedge funds who are like, hey, I think it's risky, I shouldn't be getting in, but then they see the momentum, so they kick in. After that, even the skeptics are like, hey, now I'm afraid that I'm gonna miss out on the rally, and that's pretty much the worst time. And I think that's right now, or that time is coming, where people, I've been listening to interviews on CNBC, and even the bearish people are like, hey, I thought that markets are going to go down, but obviously I have to rethink because they're pretty much going higher. So maybe I need to buy in. And that's the fear of missing out. So that's the last piece of the puzzle when everybody kicks in, gets in just because of the fear of missing out. But realistically, if you look at the earnings, if you look at the outlooks, if you look at the underlying numbers of the economy, whether it's the PMIs, whether it's the inflation numbers, yes, the picture is good, but it's nowhere close to where stocks are trading right now. And that is why I'm giving you this warning, to understand that the market is behaving this way because it's fueled, mostly started, so the fire starts with retail trading in retail options and a lot of retail inflows, then the algorithms kick in, then the hedge funds kick in, and it just fuels higher. But that, when the pretty much the retail inflows are going to stop, or there is a significant event, and again, I don't know when that's going to happen, but normally what happens when you have a rally like this and the fundamental not there, you have an even worse decline. So I will end on one note, which is pretty much the most important thing. So let me open this up. So we talked throughout 2022 how stocks are getting hurt because interest rates are getting higher. And I have the 2-year treasury here, right? So the 2-year treasury at its peak was to 4.7%. But then it went down. It went pretty much as low as 4%. So these were some of the lowest numbers pretty much at the end of 2022 and the beginning of 2023. But what has happened in the past month? From 4%, we've gone up to 4.446%. That is a huge move. And normally, what did happen throughout the year of 2022 is when we had moves like this, whether it's in the 2-year, we have the same move in the 10-year and other treasuries. All stocks fell, but especially the most kind of speculative ones like the Teslas or the GMEs or the Metas or the NASDAQ, they all went down substantially. Now we're seeing rates going up and stocks going up, which is contrary of what was happening. And I believe that's because the market is pretty much going up based on these inflows, based on the huge options positioning from retail investors in hedge funds and algorithms trying to catch up. But nothing of that is fundamental, and I believe that this sign right here, if this continues to go higher, there can be a huge market correction because the frenzy might very much be stopped in its track. So giving you all the details and information, and it will be up to you to decide what you do with that information, but definitely a big warning for markets ahead. Thank you so much, and see you in the next one.